Most of what you've been told about investing is either wrong, misleading, or at best, dangerously incomplete. After 20 years working in financial services, working with clients across the full spectrum of wealth, I want to share what I actually believe when it comes to investing. So in this video, I'm going to show you the single most expensive mistake investors make, why more effort often produces worse results, and the 3 things that historically separate people who build real wealth from those who do not. At Hoxton Wealth, we manage over $4 billion for clients globally. The lessons in this video come from seeing what works and what destroys portfolios across 2 decades and multiple market cycles. Number 1, the single biggest threat to your investment returns is not the market, it's you. Imagine 2 people invested the same amount on the same day. One checks their portfolio every week, moves things around when markets get nervous. The other forgets the password and doesn't look at it for 10 years. Almost every time, believe it or not, the second person wins. One Nobel Prize winning economist described it this way: money is like soap. The more you handle it, the less you're going to have. And yet every instinct we have pushes us to do something with it. But that instinct is a huge, huge, huge problem. So here is what the data consistently shows. If you miss just the 10 best days in the market over a 30-year period, your portfolio's end value would historically have been cut roughly in half. 10 days out of more than 10,000. The best days tend to come during the worst moments, when everything is screaming at you to sell. COVID, the Iran-US war, the Ukraine war. I can keep going on and on and on. But the answer is not to find the right moment. It's to remove the decision entirely, automate it, invest consistently, and leave the funds alone. This might seem quite strange coming from a financial planner, and it might not be easy for you to do this personally, but that is what the evidence supports. So, if the enemy is our own behaviour, what is the structural solution? That brings us to our second lesson. Number 2, most people think they need to become an expert to invest. Well, guess what? They don't. And that's good news for you. What I see constantly is someone who has worked hard for 20 or 30 years, built up real money, and then hands it off to someone or puts it somewhere they don't really understand because it sounds sophisticated and sounds like they're going to get a great return. Well, let me tell you, complicated or complex does not necessarily equal better for you, especially when it comes to investing. The reality is this: the most powerful thing you can do as an investor is also the simplest. Keep it low cost, keep it diversified, keep it consistent. That's it. The fees on complex products compound against you exactly the way good returns compound for you. If you have £1 million invested, the difference between a low cost approach and a high fee one can run into tens of thousands of pounds a year. You might also be thinking, what fees am I speaking about? The fee I'm explicitly talking about is the fee on your mutual funds or investment management approach. We can now buy tracker funds and ETF extremely, extremely cheaply. If you're paying over 1.5% just for funds alone, you need seriously to consider whether you're getting good value for this. Unfortunately, the fund management industry does not make money by keeping things simple. This is not cynicism. This is just how it works. So, what does simple actually look like in practice? That is the third lesson we're going to go through, and it's the one most people resist because it sounds too straightforward to be true. Number 3, consistent and boring done for long enough beats clever and occasional every single time. Research into the US stock market going back decades shows something very, very striking. The majority of individual companies in the market have actually had negative long-term returns. A very small number of winners have driven almost all of the gains. So think about what that means. If you're trying to pick the Nvidias while avoiding the blockbusters, even professional fund managers who do this day in and day out still get this stuff wrong. In fact, there's only a handful that have ever beat the market consecutively over a long period of time. We're talking 5 to 10, it's nothing, because no one knows, which is why investing in the whole of the market is better. Owning the whole market does not mean you will pick the winners. It means you cannot miss them. In practice, this means a low-cost, diversified fund that is explainable in one sentence. Be aware tax efficiency matters as much as where you invest. ISAs, pensions, IRAs, getting this right can save tens of thousands of pounds over a lifetime. It's important to note tax treatment depends on your individual circumstances and may change, and it's always important to get tax advice from a regulated tax advisor. Here is the summary of what 20 years in this industry has taught me. Invest early, invest consistently, keep costs low, use your tax wrappers, and get out of your own way. It's not exciting, but it's what the evidence supports. The investors who do the best are hardly ever the ones who try to do the most. There is a reason the Warren Buffetts and the Charlie Mungers of the world talk about timing the market, not timing the market. They've seen what the data shows. This massive beast of finance that you feel you need to know everything on to get right, fact is you don't. You just need to do the simple things consistently and patiently over long periods of time. That is what building wealth actually looks like. It's incredibly boring. And the reason it matters is what the number eventually gives you the freedom to do. If you'd like to understand what disciplined long-term investment strategy actually looks like for your situation, the link in the description box connects you with a regulated financial planner. If you've enjoyed this video, please like it and subscribe to the channel. Thanks very much for watching.